risk, which is your project specific risk, and then we had a market risk, and then we have country political risks. So, we have more or less completed the discussion on project specific risk as well as the market risks. So, what remains is to spend some time on the country and political risks. So, that is what we will do from now on. But before we actually do that, let us try and discuss first the questions that we had at the end of the previous lecture. So, we had 2 questions at the end of the previous lecture. The first question was, in risk management and contracting, one often encounters a phrase called a direct agreement. Okay. So, what is a direct agreement and what are the purposes of that agreement? So, generally we have a very strong contractual framework in a project finance structure, right. So, you have several different types of contracts. Let us look at some of them. So, you have let us say fuel supply contract, and then you have power purchase agreement, then you have your EPC contract, then we have your O&M contract, and then we also talked about insurance, which essentially is not a contract, but nevertheless is a very important part of project finance security structure, right. So, in each of this case we have different contracting parties. So, in a fuel supply contract, the contracting party is a fuel supplier. In a power purchase agreement, it is a power purchaser. In the EPC contract, it is a construction and other people who are involved in constructing the project. In the O&M contract, it is basically the party who is going to do the operations and maintenance after construction. And then you have insurance, where the contract is with the insurance company. So, what you actually notice, all of them will actually sign the contract with the project company, right. All of them will sign the contract with the project company. So, this contract is a very important part of the project security for lenders, because the project as it is does not really have any collateral or asset. Let us say if it is for a toll road project, there is no ownership of the assets on the project company, but the contractual agreement, the concession agreement gives the right to the project company to collect tolls, and the ability to collect tolls is a big asset, right. So, that is a main source of security, that is a main source of comfort for the lenders. So, obviously if there is any default on the project company in honoring any of these contractual commitments, then the lenders are going to be affected. So, let us say for example, in the case of a power purchase agreement, if the project company is not in a position to supply power as written in the power purchase agreement, then there is what is called as a contractual failure, right. Then there is an inability of the project company to generate revenues, or it might even have to pay penalties. So, whenever such situations occur, it will actually affect the lenders as well, because more than anyone else the lenders have invested a lot of capital in the project. Okay. So, the lenders would want to secure their interest in the project. The lenders would want to in addition to ensuring that there are various contracts to mitigate the risk, the lenders would want to actually have some kind of a direct oversight in terms of how the company has been meeting the various contractual obligations. Okay. So, in all these contracts by and large there will be a direct agreement with the lender as well. So, for example, in a fuel supply contract between the fuel supplier and the project company, there will be a clause which will indicate the participation of lender if the project company is not in a position to honor the obligation. So, that is a direct agreement, right. The agreement where the lender also comes into the picture in any of the contracts that the project company has signed. So, now let us get into a little bit more detail as to why do we actually have these kinds of direct arrangement. So, as we have See, just now the security interests of the lenders is acknowledged by having these kinds of direct agreement. So, now the contractors know that the lenders actually have lenders actually have invested in the project, and for that investment they actually need security, and then the contractual payments is actually a form of security to the lenders. So, the security interests of the lenders will be acknowledged through this direct agreement. Okay. So, whenever we have direct agreements, there are several provisions that come along with it. So, for example, any contractual payments that come into the project have to be made in a specific bank account as notified by the lenders. Let us say, for example, there is toll revenue, there is revenues from sale of power, whatever it may be. All of those revenues should be actually made into specific designated bank accounts as mentioned by the lenders. So, when you actually do so, when there is an agreement to the effect between the power purchaser and the lender and the project company. So, the direct agreement will simply say that all the payments from the power purchase agreement will be made to a specified bank account as mentioned by the lender. So, that is a direct agreement, right. So, when you have this kind of a direct agreement, the lenders are able to monitor the cash flows to that account in a lot more effective way. So, the lenders do not need to get information from the project company. The lenders can simply monitor the specified bank account to ensure that the monies are coming into the account properly, because if the monies are coming into the account properly, that means that the company is generating power and there is a power purchaser who is buying it, and then he is making the payments on time. Okay. So, this also this direct agreements helps a lender to monitor their investments a lot more effectively, because bank information being a lot more credible than any information that can actually directly come from a project company gives a lot more comfort to the lenders. The other advantage of a direct agreement is whenever there is a default on the part of the project, lenders are notified. Okay. Sometimes the project company would probably not reveal all the information to the lenders or to the investors for various reasons, but lenders would like to know if there are any potential problem areas, if there are any defaults that the project company has made, because any contractual default can actually trigger several reactions. For example, there could be threat of bankruptcy, there could be a threat of cancellation of a contract leading to loss of revenues, and so on and so forth. So, should any such event occur, it will adversely affect the lender's investment in the project. So, the lenders would like to know that the project is functioning properly, or if the project is in default, then the lenders should be aware of it so that they can take some corrective action. Okay. So, a direct agreement will help the lenders know about any potential default. So, in addition to telling the project company, all these counterparties to the contract will also indicate the potential default to the lenders. And lenders are given cure periods to remedy the company's default before the contract is terminated. So, there are several reasons why the contract could be terminated. For example, the project company has not been very sincere, there has been too much of delays, and there is a lack of interest, or whatever it may be. There are several examples. Let us say, for example, in a road project, the concession agreement will clearly specify the concession, the construction time frame, and so on. But if the project company is not been able to complete the project within an agreed time schedule, right, then obviously the government can step in and then they can cancel the concession agreement. Right. So, when they cancel the concession agreement, then the lenders are going to be adversely affected, because they have actually made an investment in the project, and if a concession agreement is cancelled, then it may be very difficult for them to recover their investment. So, whenever there are such potential termination that could arise, then the direct agreement has a provision for what is called as a cure period. That is, the lenders have kind of indicated to give them a chance, the lenders should be given a chance so that they can actually rectify any potential shortcomings that the project company has faced. So, if there is a delay in project completion, the lenders can ask for additional time so that the lenders will be able to rectify those issues, and then the project can begin. So, this actually ensures that the lenders' investment is safeguarded, that the lenders are not entirely dependent on the project. In a way, they are entirely dependent on the project company, but if there is any problem, they are given a chance to set it right, so that it can help them to recover their investment. There are also other rights that are normally included as a part of this direct agreement. One is called as your step-in rights, and the other is your substitution rights. Okay. So, step-in rights essentially indicates that if the project company is not being able to manage the project properly, then the lenders can step in, the lenders can remove the existing management of the project company, and they can actually take over the management of the project company. Okay. So, that is called as your step-in rights. And the substitution rights is very similar. Instead of the lenders coming in and taking over the operations of the project company, the lenders can substitute a project company to another company who will take care of the operations. So, in both these cases, we are essentially talking about a situation where the existing project management of the project company is replaced by another. So, in the case of a concession agreement, the existing concessionaire might be replaced with another concessionaire to take over the operations of the project. So, people might actually question, right, if the promoters of the project have not been able to succeed in implementing the project, lenders who are only financial investors, what is the probability of them being successful in rectifying the default? Okay. So, the chances are slim, because the promoters who have a lot of experience in operating the project, if they have not been successful, how can financial investors like banks can cure the default? But the objective of the step-in rights and substitution rights is not to actually test the management capabilities of the lenders, but it is just a clause which indicates that if there is such an occasion in the future, then the lenders will be given a choice to rectify the default. The lenders agreement clearly specifies these kinds of rights essentially to kind of give some safeguard for the investment made by the lenders. So, if such direct agreement is not there, then it might have been very difficult for some of these safeguards to have been incorporated. Okay, now let us go to the second question. The second question that we talked about was, in a swap arrangement, neither side is lending the other any money. In that case, there is any credit risk in such a transaction. Okay, so essentially we looked at interest rate risk, and in interest rate risk we said that there are several ways in which people manage the interest rate risk, and one such common way in which people manage interest rate risk is to actually have a swap contract. Okay. So, what is actually swap? Swap is essentially, in simple English language, it is nothing but your exchange, right? Nothing but your exchange. It is nothing but your exchange. So, we are exchanging something for another thing. So, what are we exchanging in the case of interest rate risk management? So, we are exchanging what is called as a floating rate interest with a fixed rate of interest, floating rate of interest with a fixed rate of interest. So, normally financial institutions do not provide loans on fixed interest mode, and they always benchmark to some particular index rate. But at the same time, if the interest rate is completely made floating rate, it creates a lot of interest rate risk for the lenders. For example, if the benchmark rate increases, then the coverage ratio reduces, and this reduction in coverage ratio might not be acceptable to the lenders. So, therefore, they will insist on some kind of hedging mechanisms to overcome the interest rate risk. So, one common hedging mechanism is your swap. Okay. So, in a swap what happens? A project company which actually is borrowed at a floating rate of interest, it signs up a swap contract with a swap provider, which makes it to exchange its floating rate of interest loan with a fixed rate of interest loan. Okay, let us see how it actually works. Okay. So, let us say the situation is something like this. So, there is a loan which has a principal outstanding of, let us say 1000. Okay. And let us assume that the interest is paid on a 6 monthly basis, and the interest is structured on a floating rate. Let us say, for example, the LIBOR rate is used to calculate the interest rate for the loans. Okay. And then in addition to that, the project company has entered into a swap contract at a fixed rate of interest. Right. This is a swap contract at a fixed rate of interest. So, the fixed rate of interest for a swap contract is, let us say, 6%. Right. And then the interest rate for LIBOR is, let us say, 4%. Right. So, I am talking about this interest on a 6 monthly basis. So, for example, 4% interest rate for 6 months. So, that means the annual LIBOR rate will be 8%, and similarly the swap contract is 6% for 6 months, the annual swap contract will be 12%, that is a fixed rate. Okay. So, now if the LIBOR rate is 4% and the swap contract rate is 6%, and if the project company has signed this kind of a swap contract, how do the payments work? So, let us look at first the project company. So, the project company will have to pay, let us say, if it is a LIBOR rate, they will have to pay an interest of 40. Right. They will have to pay an interest of 40, and then in addition to that, there is swap payment, because there is the fixed interest rate 6% that has been signed. The difference will have to be paid to the swap provider. So, the difference is 2%. So, the swap payment will be 20. So, the total payment to the swap provider is 60. Right. So, this is your 6% rate of interest to the project company. Now, the counterparty to the swap contract is the swap provider. It is a swap provider. So, let us look at how the payments for the swap provider work out to be. Okay. So, for the swap provider, they receive from the project company, 60. Right. They receive from the project company 60. But the actual LIBOR interest rate is only 40. Right. The actual LIBOR interest rate is only 40. So, they actually make gain of 20. Right. The project company makes a gain of 20, and then the payment to the lender is 40. So, this is your 4% LIBOR rate. So, the project company, for them, because of the swap contract, the effective interest rate works out to be 6%. For the swap provider, the effective interest rate works out to be what the LIBOR is, which is 40. Now, this is the case where the LIBOR rate is lesser than the swap LIBOR rate is lesser than the swap rate of 6%. But what happens over a period of time, the interest rate changes, and then the LIBOR rate increases more than the swap contract. Okay. So, let us say for a particular period the LIBOR rate is 7%. The LIBOR rate is 7%, and the company has a swap contract at 6%. Okay. So, the project company will have to pay a LIBOR interest rate of 70, but because they have actually signed a contract for swap at 6%, and since the benchmark rate is more than the swap contract rate, the swap provider will make a payment, right. The swap provider will make a payment to the project company, which is 10, which is the difference between the interest rates of LIBOR and the swap contract, and therefore the effective payment for the project company is 60. Right. The project company still pays a 6% rate of interest as signed in the swap contract. The difference is actually the payment that it has received from the swap provider. So, now what happens in the case of a swap provider? They receive 60 from the project company, but since the LIBOR rates are more, there is no longer a gain to the swap provider. So, there is essentially what is called as a loss, and this loss is nothing but 10, and then the payment to the lender is 70. So, the swap provider essentially absorbs the risk of interest rate fluctuation, right. So, that is what we actually see. Now, who is a swap provider? Normally a swap provider is a bank. Okay. So, the question that you might actually have is, why should the project company actually take loan from a bank on a floating rate basis and then go for a swap contract with another bank to make the interest rate more or less fixed? Okay. So, the question is, why can't the project company directly go for a fixed rate loan, because in both the cases, either in terms of taking a loan or in terms of taking a swap contract, in both the cases it is actually the bank that is involved. So, the response to that is, whenever the project company is actually taking a loan which is specifically long term, the bank might not be in a position to take the interest risks. For example, if there are any major changes in the interest rates, then if it is a fixed rate loan, then the bank will actually have to absorb this interest rate risk, which the bank is not willing to do. So, therefore, the lending is in terms of floating rate basis. In the case of a swap provider has probably much better access to short term funding to take care of this interest rate risk. Let us say, for example, the interest rate keeps changing from one year to the other year. So, any changes in the interest rates in terms of incurring a loss and all of these things can be mitigated if the swap provider has good access to short term funds. It is not really the long term funds in the case of a swap provider, because the interest rate keeps changing at short notices. Since these are two different entities, in most cases you may actually find a swap provider may be a different as compared to the lender, right. And the strengths of these banks are also different. If it is the same bank, then it is all essentially two different divisions, right. The strength of one division is different from the strength of the other division. So, because of these reasons, we actually find two separate contracts for loans as well as for swaps. Now, the question is there a credit risk? Okay. Is there a credit risk in this case of a swap contract? Because in the case of a swap provider, he does not provide any money to the project company. He just provides a guarantee of a fixed rate of interest as for the project company is concerned. So, if we really look at, is there a credit risk for the swap provider? To a certain extent we may say yes, there is. So, let us look at a transaction of a swap contract. So, here is a project company. On this side there is a lender and on this side there is a swap provider. So the project company will have to pay the lender on, let us say, a floating rate of interest. Let us say in this case it is your LIBOR. So they actually pay interest rate at, let us say, the case of LIBOR, and the project company actually has an arrangement with the swap provider at, let us say, a fixed rate of interest. Let us say, for example, this is 8%, right? And the swap provider in turn provides the LIBOR rate of interest, right, which it actually passes on to the lender. So when a project company enters in a swap contract with the swap provider is obviously exposed to a certain level of interest rate risk, and he will have to make other arrangements to take care of the position that he has taken by signing this swap contract, right. If he actually signed a swap contract in exchange for a floating rate and a fixed rate loan, then in some case he might have to unwind his position by signing another contract, or he should have made some arrangements to ensure that he is able to satisfactorily honor the swap contract during the loan period. If the project company defaults on the loan, right, if the project company defaults on the loan and it does not make any payments to the lender, then obviously the swap contract becomes void, right. The swap contract comes into the picture only if there is a valid loan between a project company and the lender. So if the project company defaults on its loan and it obviously does not pay the fixed rate of interest to the swap provider, then the position that the swap provider has taken is going to be unbalanced, because the swap provider has already signed another contract to take care of this position that he has sold to the project company. If default of the project company happens, then the swap provider is going to be left high and dry. He will actually be holding a swap contract without any counteracting contract. So to that extent, the swap provider is actually taking a credit risk on the project company. The credit risk here is that the project company will be able to satisfactorily operate and will be able to continue servicing the loan of the lenders. There will be no default made by the project company. So if the project company defaults, then the swap provider will have to find another project company to actually take care of this unbalanced position that it has signed. So that is going to incur additional cost for the swap provider. Let us say, for example, in the meanwhile, if the LIBOR rate has reduced, right, if the LIBOR rate is reduced as compared to the time when the swap contract was signed on, then any new company will not be in a position to sign a fixed rate at 8% rate of interest. They may actually want to sign a swap contract at a much lower rate of interest. So breaking these kinds of swaps when the interest rate has gone down is going to incur additional cost for the swap provider. So even though there is no money transaction involved between the project company and the swap provider, because of the fact that there could be a potential breakage cost if the project company is not able to honor, if the project company defaults on the payments to lender, the swap provider also assume some kind of credit risk of the project company. It may not be really very large, but there is a certain level of credit risk that is assumed by the swap provider, even when there are no lending involved, when there is no money involved in a swap contract. Okay, I mean actually the swap contracts and some of the hedging contracts are a topic by itself and could be quite complicated, but I am just trying to give you a flavor of what is actually possible through such hedging instruments. I mean, if you like to know more about these kinds of techniques, then there are a lot more advanced reading material that is available, and I would encourage you to look at those readings to know a lot more about, let us say, a forward contract or a swap contract and any other type of hedging strategies used in the case of infrastructure sector. Okay, now let us get back to the third type of risk that we had talked about, which is your country risk or political risk. Now, if you really look at it, most of these infrastructure projects are very large projects, right. So, it is supposed to actually have a significant impact on society, significant impact on development, and it calls for a lot of investment, and it also provides a lot of other developmental benefits in terms of generating employment and so on and so forth, right. So, because of the fact that these projects are very large, have long term investments, there is a need for sustained political will and support, right. Without this political will and support, these projects cannot actually take off, or even if it is taking off, it is going to be purely on a temporary basis. I mean, it is very practically it is not possible to implement major projects now without any structured political backing. For everything we need a lot of political support. So, I can talk about an example, right. So, this was an example that we saw in the early part of 1990s. That was a time when India was actually going through a process of liberalization and reform and so on. So, the first sector that was actually to be reformed in a major way was the power sector. So, earlier the power sector was a vertically integrated structure. So, you have generation, transmission and distribution in a single entity, and then because of various reasons adequate investment was not happening in the in the power sector. So, there was a lot of shortages of power and so on and so forth. So, what the government decided was to actually unbundle the power sector. So, that means instead of having as a single entity, you have 3 different entities managing generation, transmission and distribution, and to ensure that the sector functioned properly and efficiently, there was also a regulatory authority that was created. So, this entire process of power sector reform was actually started in the beginning of 1990s. So, there were several state governments which actually reformed their power sector and so on. So, the earliest power sector reform actually happened in a state of Orissa. So, Orissa over the years was a power surplus state because it had a lot of hydel resources, it probably had a lot of coal resources as well, but over a period of time because of lack of investment, the state was actually experiencing power shortage. And because of the fact that Orissa was not as developed as the rest of the other states, it was finding it difficult to actually attract investments. Remember, those were the days when power sector was not thrown open to private sector in a major way. All the investment will actually have to come from the government, and the state government was not in a position to actually make any further investment in the power sector. So, that was also the period when people started looking at private sector investment and infrastructure, where we can actually create appropriate structures that will actually facilitate private investment in the power sector. So, but for private investment to happen, the sector will have to be first reformed, so that you can actually enable to receive private sector investment. Okay. So, the first step that actually happened in this power sector reform was to what is known as unbundle the vertically integrated structure. And there were separate companies created for generation, transmission and distribution. So, this was a very major decision that was done by the state government, and it needed a lot of political support and backing. The reason behind it was doing this reform was also due to the conditionality of the World Bank. World Bank at the time said that we will be prepared to assist the power sector in Orissa, but not in the current way in which the sector functions. And the World Bank then said that if the government is willing to reform the power sector by unbundling and by facilitating private sector investment, then the World Bank can actually make an investment in the power sector in Orissa. So, it was a conditionality of the World Bank which kind of pushed the Orissa government towards implementing reform. But nevertheless, when the World Bank decided to support the Orissa power sector, it first gauged the support and the commitment of the government to implement the reform, because once an investment is made and the government backtracks, it is going to be very difficult for anybody to recover their investment. So, before any investment is made, obviously there is a lot of checks and balances. People actually look at validating the commitment, validating the seriousness of the government in implementing some of these reform programs. So, specifically the World Bank mentions that a communication from the Chief Minister's office highlighting the strong support from the government to power sector reform was a significant factor in ensuring the support of the World Bank. So, World Bank provided substantial financial support to strengthen the Orissa power sector, but then that support would not have come without the strong showing of commitment on the part of the state government. So, just as we check for commercial viability for any project, it is also important to check the political viability. Is the government willing to actually make some tough decisions? Is the government willing to actually give autonomy to the private sector rather than interfering in the private sector? So, these are all broadly classified under what is called as your political risks. Now, I can tell you another example of how critical is the support of the government. So, let us say we have a water supply services, and this water supply services is actually being privatized, and the private contractor is responsible for all the activities related to water supply. So, that means supply of water and then generating bills, distributing bills to the different customers, and then collecting the payments for the water that is being supplied. Now, if the consumers after consuming water do not actually pay for the services, then the private sector will have to actually take some action. So, they can actually do two things. One is they can actually make the customer pay for the support that they have received, and on its own the private operator might find it very difficult to enforce the customer. So, it will actually have to have the support of law, it will actually have to have the support of police to enforce payment on the part of the non-paying customer. So, this support from the police, this support from the law is not going to come unless until there is a political support. So, this political support is very critical for private sector infrastructure projects specifically. So, whenever there is a change in the political attitude, whenever there is a change in the political support, it can actually impact the viability of the project, it can actually impact the functioning of the project. So, anything that will impact the functioning of the project, anything that will impact the viability of the project which can be attributed to a political action is called as political risk. So, the question is, what creates political risk? A major debate that is actually seen in the infrastructure sector is when private investors demand higher return, is it because they fear political risk, or when the projects start getting higher returns, are they getting more exposed towards political risk? So, the traditional finance says that when the risk is higher, the investors would expect to get higher returns. The investors would demand higher returns to compensate for the higher level of risk. But there are studies specifically in the infrastructure sector which indicates that when the projects start getting higher returns, right, when the investors in the project start getting higher returns, this is not seen as politically acceptable, right, because the governments would always want the investors to earn moderate returns and then pass on the benefit of lower returns in terms of lower prices to the consumers. Now, when consumers are paying a high price and this in turn increases the returns for the project investors, then the government feel that it is not a politically good situation. Water supply, electricity, sewerage services, roads, transportation. So, these are all very important topics that can actually impact day to day economic activity, and any perception that private investors are actually making too much profit will not be politically acceptable for the government. So, the thinking is whenever projects are earning higher returns, then they actually are susceptible for higher degree of political risk. Okay. So, the political risk can actually happen by many types, which we will see shortly, but ultimately the argument is little reversed in the case of political risk. When projects are seen as earning moderate returns to low returns, there is very little interference from the political side, but the moment that a project is seen as earning excessive returns, then it is not acceptable and it also increases the political risk that the project is exposed to. How does political risk affect the project? When does it affect the project, and how can it be mitigated? So, these are the three broad questions that we will try and address, like we have been doing in the previous research categories, the risk categories as well. So, how does it affect the project? When a project is exposed to political risk, sometimes the license can be cancelled, the concession agreement can be terminated, there could be opposition by the citizenry. It is very difficult to actually identify clearly whether it is politically motivated or whether it is because of some other reason. But ultimately political risk affects a project by way of its ability to function as expected. Could be problems in terms of revenues, there could be damages to the project, and so on and so forth. So, it affects the project in a fairly significant way. And when does it affect the project? So, generally you actually find the governments are very keen to actually get investments. So, most of the time the political risk is seen after the project begins operations, because before the project begins operations, the investment is still flowing into the project. In some sense, it is actually creating some kind of a benefit by generating employment and through investment inflow and so on and so forth. But only when the projects start earning revenues, only when the returns are seen as excessive, the political risks, the shadow of political risk becomes higher. So, dominantly it actually affects the project in the operations phase more than the construction phase. And how is it mitigated? It is mitigated like we have seen the various contractual mechanisms. There are specific ways in which people try and mitigate the political risks. So, we will see some of the ways in which people mitigate political risks in the case of infrastructure projects. Political risk can be broadly classified into three categories. talk about investment risk, talk about change of law risks, and then talk about the quasi political risks. So, each of them can be attributed to, or it manifests in a particular fashion, and mitigating them is also done by a variety of means, right. So, we actually use a different type of route to mitigate investment risk, and we also use probably a different kind of strategy to mitigate change of law risks and so on, right. So, what we will try and do is we will try and understand the features of some of these risks in more detail, and how we are actually able to mitigate this risk. What are the common approaches that private investors do to mitigate this risk in the next lecture. But before we actually do, I have two questions for this lecture. The first question is, when we talk about political risk, is it a concern only when we actually have a foreign investor, right. Let us say for example, the project is being developed entirely by domestic investors, there is no foreign capital involved. In this case, do we really have a political risk? The second question is political risk a feature only seen in developing countries, or is it something that is pervasive worldwide, that is, do we also see political risk in developed countries? So, think about it, and we will discuss it in the next lecture.